Hey everyone, Alex G here, and welcome back to the channel. For those of you who are new here, I'm Alex, and on this channel, I break down everything related to world economy and personal finance to help you make smarter decisions with your money. If you want to stay updated on the biggest economic shifts, market movements, and financial strategies that actually matter, make sure you hit that subscribe button and turn on notifications right now. And if you've been rocking with me for a while, drop OG Alex G in the comments so I can show you some love. Now let's get into today's topic because what I'm about to share with you is absolutely massive. Silver just crossed $100 per ounce for the first time in history. If you're watching this, you're witnessing one of the most significant commodity events of the decade, and I'm going to tell you why this is just the beginning. Today we're diving deep into silver's explosive rally to $100 per ounce, a milestone that seemed impossible just 18 months ago when silver was trading around $30. We'll analyze what drove this historic move, what the experts are saying, and most importantly, where silver could be headed next. Make sure to stay with me until the end because we're going to cover strategies for investors and what you need to watch for in the coming weeks. On January 23, 2026, silver achieved what many thought would take years. It crossed the $100 per ounce threshold. At the time of the breakthrough, the spot price reached $101 per ounce, marking an all-time record high. But here's what makes this even more remarkable. Just look at these numbers. Silver started 2025 at around $30 per ounce. By January 2026, it was trading around $80. Within just 3 weeks of the new year, it surged to $100. That represents a gain of nearly 200% from January 2025. In the past month alone, silver climbed over 40%. To put this in perspective, gold also hit record highs, trading just shy of $5,000 per ounce. But while gold's 2025 performance was impressive at 65%, silver absolutely crushed it with a 170% gain in the same period. This wasn't an overnight phenomenon. The silver market has been building toward this moment through a perfect convergence of factors. First, we saw record-breaking momentum through late 2025. Silver was setting new all-time highs almost weekly in December, pushing past the previous psychological barriers of $50, $60, $70, $80, and $90. Second, the momentum carried into 2026 with extraordinary strength. When markets reopened after the new year, instead of taking a breather, silver just kept climbing. And third, and this is critical, the breakout to $100 came with significant volume and conviction, not just speculative froth. This suggests real, sustained demand rather than a temporary spike. Now let me break down the 5 pillars driving silver's surge, and pay close attention because understanding these will help you understand where this market is headed next. Here's something most investors don't fully appreciate. Silver isn't just a precious metal anymore. It's become a critical industrial commodity that's absolutely essential to the modern economy. Industrial fabrication demand hit a record 680.5 million ounces in 2024, and it's continued climbing through 2025 and into 2026. The solar energy sector alone now consumes over 30% of industrial silver demand. Think about that. Nearly 1/3 of all industrial silver goes into photovoltaic panels. Each solar panel contains 15-25 grams of silver, and with global solar installations potentially topping 500 gigawatts annually by 2030, we're looking at around 250 million ounces of annual silver demand just from this one sector. But it doesn't stop there. Electric vehicles are becoming a massive consumer of silver. While a traditional gasoline car might use 15-28 grams of silver, a hybrid uses 18-34 grams, and a full battery electric vehicle uses 25-50 grams. With global EV production expected to grow at 13% annually through 2031, automotive silver demand could triple by 2030. Then you have the AI and data center boom. The report from the Silver Institute shows that global IT power capacity has increased 53 times since 2000. That's a 5,252% increase. Every data center, every server, every piece of AI infrastructure requires silver for its superior electrical and thermal conductivity. The bottom line? Silver has transformed from being primarily a monetary metal into the next generation metal that's indispensable for the green energy transition and digital transformation. Here's where things get really interesting. The silver market has been running a deficit for 5 consecutive years. That means demand has exceeded supply for half a decade. In 2025, analysts projected a market deficit of roughly 149 million ounces. And here's the kicker. There's no quick fix for this. About 72% of primary silver is produced as a byproduct of mining other metals like copper, lead, and zinc. You can't just flip a switch and produce more silver when prices rise. Mine production is essentially flat. New silver mining projects take years to develop, and we're not seeing a pipeline of major new production coming online that would meaningfully change the supply picture through 2026 and 2027. Meanwhile, above-ground inventories have been steadily declining. The physical silver market has been so tight that industrial buyers are increasingly worried about securing supply, regardless of price. This is Economics 101. When you have rising demand colliding with constrained supply, prices have to adjust. And boy, have they adjusted. Let's talk about the elephant in the room, the broader economic picture. Inflation has proven stickier than central banks hoped. The latest U.S. inflation report showed rates holding at 2.7%, still well above the Federal Reserve's 2% target. When inflation persists, investors historically rotate into hard assets like precious metals. But it's not just inflation. We're seeing massive geopolitical tensions that are reshaping global finance. The situation with Greenland, U.S.-Europe relations, trade policy uncertainty under the new Trump administration, and ongoing conflicts in the Middle East, all of these factors are driving investors toward tangible assets. There's also growing concern about currency debasement and the long-term purchasing power of fiat money. Central banks worldwide continue to diversify away from dollar-denominated assets, and silver benefits from this trend alongside gold. The Federal Reserve is expected to keep rates unchanged in the near term, but markets are still pricing in potential rate cuts later in 2026. When real interest rates are low or negative, non-yielding assets like silver become more attractive because the opportunity cost of holding them decreases. Silver surged toward $99, $100, partly because the U.S. dollar came under pressure. Shifting geopolitical dynamics, particularly around U.S.-Europe relations and concerns that Europe could weaponize its substantial holdings of U.S. assets, weakened the greenback. A weaker dollar makes dollar-denominated commodities like silver cheaper for foreign buyers, increasing demand. It also reflects broader concerns about U.S. asset appeal, which drives capital toward alternative stores of value. This might be the most underappreciated factor. Institutional investors are fundamentally rethinking how precious metals fit into modern portfolios. In September 2025, Morgan Stanley's chief investment officer publicly endorsed a 60-20-20 portfolio allocation. That's 60% stocks, 20% bonds, and 20% gold. For an industry that's been anchored to the 60-40 stock-bond split for decades, this is revolutionary. Bank of America analysts noted that investor holdings of gold via ETFs, bars, coins, and futures have grown significantly, but gold's share of total assets under management still has room to expand from around 2.8% toward 4 to 5% or higher. Here's the math that should concern silver bulls and bulls alike. If U.S. retirement accounts alone allocated just 20% to gold, that would create roughly $9.16 trillion in new demand, more than 44 times annual global mine supply. While those projections focus on gold, silver benefits tremendously as well. Many investors view silver as leveraged gold. It tends to move in the same direction, but with greater volatility and often larger percentage gains. Let's look at what some of the most respected names in precious metals are forecasting. Bank of America, Michael Widmer, head of metals research, has stated that silver could rise to between $135 and $309 per ounce in 2026. That's not a typo. Their base case suggests silver could more than double from the $100 level. Citigroup analysts see silver hitting $100 per ounce in Q1 2026, citing heightened geopolitical risks, ongoing physical market shortages, and renewed uncertainty around Federal Reserve independence. Well, we're already there. UBS is calling for gold to reach $5,000 per ounce by Q1 2026 amid a broader commodities rally, which would likely pull silver significantly higher as well. JP Morgan, while their primary focus has been on gold reaching $5,000, $6,000, they note that central bank and investor demand will remain strong, supporting the entire precious metals complex. Keith Neumeyer from First Majestic Silver, known as the triple-digit silver guy, Neumeyer has been calling for 100-plus stock silver for years. After silver broke through $93, he stated that triple digits is definitely on its way. He's even suggested that if gold hits $10,000, silver could reach $1,000, though that's admittedly a more extreme scenario. The LBMA's annual survey of metals watchers found that analysts see precious metals breaching new highs throughout 2026, including gold potentially reaching $6,000, $7,000, silver hitting $160, and platinum potentially seeing highs over $3,000. The consensus view identifies three main drivers: geopolitical risk and uncertainty, central bank buying, and U.S. monetary policy and interest rates. Not everyone is uniformly bullish, and it's important to present both sides. Heraeus Precious Metals expects prices for silver to trend lower for at least the first part of 2026, anticipating a period of consolidation after such dramatic gains. They forecast silver in the 43.62 range, suggesting significant downside from current levels. Their argument is that after record highs, markets typically digest gains before moving higher, and that photovoltaic demand may face headwinds as efforts to reduce silver content in solar cells accelerate. However, even Heraeus acknowledges that once this consolidation ends, further price appreciation is anticipated. One of the most important metrics for silver investors is the gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has varied widely. In recent years, it reached extreme levels near 100.1, meaning you needed 100 ounces of silver to buy 1 ounce of gold. That reflected silver's severe underperformance. But as of January 2026, that ratio has compressed dramatically to approximately 51.1. That's nearly a halving of the ratio, signaling a sharp revaluation in silver's favor. Here's why this matters. Many analysts believe silver is still undervalued relative to gold, even at $100. The production ratio of silver to gold is roughly 9.1, meaning 9 ounces of silver are mined for every ounce of gold. If silver were priced according to the production ratio and gold is at $5,000, silver should theoretically be around $555 per ounce. Now, markets don't necessarily price things purely on production ratios, but it illustrates how much room silver potentially has to run. Some analysts suggest the gold-silver ratio could compress to 40.1 or even 30.1 if silver's industrial demand story continues to strengthen. At a 40.1 ratio with gold at $5,000, silver would be 125. At 31, it would be 167. Now, before you run out and dump your life savings into silver, we need to talk about the risks, because they're very real. The solar industry is working hard to reduce silver content in photovoltaic cells through thrifting and developing alternative technologies like copper plating. If successful at scale, this could reduce per-unit silver consumption even as total installations grow. Similarly, the electronics and automotive industries are constantly exploring ways to use less silver or find substitutes, particularly at these elevated price levels. A severe global recession could dampen industrial demand. If economic growth stalls, demand for solar panels, EVs, and electronics could all take a hit, potentially offsetting supply deficits. Silver is known for extreme volatility. The same momentum that drove prices to $100 could reverse violently if macro conditions shift or if large speculators decide to take profits. Silver has a history of spectacular rallies followed by equally spectacular corrections. Anyone who bought near the 2011 peak of $49 waited over a decade just to break even. While new mine supply is constrained in the short term, significantly higher prices will eventually incentivize more production. Additionally, recycling could increase substantially if prices remain elevated, adding to available supply. Changes in green energy subsidies, trade policies, or environmental regulations could all impact silver demand trajectories. So what comes next? Most analysts expect continued volatility with an upward bias. The momentum that carried silver to $100 appears strong, supported by ongoing supply deficits, strong industrial demand, persistent macro uncertainty, and positive technical momentum. Consolidation between $90 and $110 seems likely as the market digests these gains. However, a push toward the $120 to $135 range is certainly possible if current trends persist. Watch for key levels. Support appears strong around $90.95. If that breaks, we could see a swift pullback toward $80. On the upside, 110s and 125s are the next major psychological barriers. Looking at the medium term over the next 6 to 18 months, forecasts diverge significantly. Bulls see silver continuing toward $150 to $200 based on deepening supply deficits, accelerating industrial demand, potential Federal Reserve rate cuts, continued central bank diversification, and growing investment allocation to precious metals. More conservative analysts see a range of $80 to $120 as silver consolidates and industrial demand adjusts to higher prices. The long-term structural story for silver through 2027-2030 remains extremely compelling. Solar installations are expected to continue aggressive growth. EV production is forecast to expand significantly. AI and data center build-out is still in early innings. Limited new mine supply is coming online, and persistent deficits are likely through the end of the decade. Some of the more aggressive long-term targets include $160 from LBMA survey respondents, $200 to $300 from various independent analysts, and $309 from Bank of America's upside scenario. Could silver really reach these levels? The industrial demand fundamentals suggest it's possible, particularly if we see continued supply constraints and expanding investment demand. Now let's talk strategies for different types of investors. If you're just getting started with silver, don't chase. After a 200% rally, buying at the top is risky. Consider waiting for pullbacks to $90-$95 levels if you're new to the space. Start small. Silver's volatility means you should size positions appropriately. Many advisors suggest 5 to 15% of portfolio in precious metals total, split between gold and silver. Understand the products. You can invest through physical silver like coins and bars, silver ETFs like SLV or SIVR, silver mining stocks, or silver futures for sophisticated traders only. Each has different risk profiles and costs. If you already own silver, consider taking some profits. After 200% gains, there's nothing wrong with selling a portion and locking in returns. You can always buy back on weakness, rebalance if needed. If silver is now 30% of your portfolio when you intended 10%, consider trimming. Hold a core position. If you believe in the long-term structural story, maintaining a core position makes sense even through volatility. For those interested in miners and mining stocks, silver mining stocks offer leveraged exposure, but come with operational and company-specific risks. They haven't kept pace with silver's rally in many cases, which could represent opportunity or could signal skepticism about sustainability. Companies worth researching include First Majestic Silver, Pan American Silver, Wheaton Precious Metals, and others. Do your due diligence. What we're witnessing with silver may represent a fundamental re-rating of hard assets in the global financial system. For decades, the traditional 60-40 portfolio of stocks and bonds was gospel. Precious metals were viewed as relics or fringe holdings. But that's changing. The combination of persistent inflation concerns, currency debasement fears, massive government debt levels, geopolitical fragmentation, and the rise of real industrial demand for silver specifically is forcing a rethink of what belongs in a balanced portfolio. Unlike gold, which is primarily a monetary metal and store of value, silver has this unique dual character. It's both a monetary asset and an indispensable industrial commodity. This makes silver's story particularly compelling. Even if investment demand cools, industrial demand provides a floor. And if industrial demand plateaus, investment demand can drive prices higher. This dual nature also means silver can outperform in multiple scenarios. During inflation, you get safe haven demand. During economic growth, you get industrial demand. During monetary uncertainty, it serves as an alternative to fiat. And during technological booms, it's a critical input material. We can't ignore the broader trend of de-dollarization happening globally. Whether it's Trump's aggressive stance on Greenland, actions in Venezuela, or general trade tensions, these factors are pushing countries to diversify reserves away from dollar assets. Central banks have been consistent buyers of gold, and while they don't typically buy silver for reserves, the trend supports the entire precious metals complex. Let me leave you with the key points to remember. 1. Silver crossing $100 is historic, but it may not be the end of this rally. The structural drivers, industrial demand, supply deficits, and macro uncertainty remain firmly in place. 2. This isn't just speculation. Real industrial demand from solar, EVs, AI, and electronics is fundamentally changing silver's role in the global economy. 3. Expert forecasts vary widely, from conservative consolidation scenarios around $80-$100 to aggressive targets of $150-$300. The truth is probably somewhere in between with significant volatility along the way. 4. The risks are real. Technology substitution, economic slowdown, and silver's historical volatility mean this isn't a one-way bet. 5. For investors, the key is having a strategy that matches your risk tolerance and time horizon. Whether that's taking profits, maintaining core positions, or waiting for better entry points depends on your individual situation. We're witnessing a major moment in commodity markets. Whether silver consolidates here, pushes to $150, or corrects back to $80, the underlying story of constrained supply meeting surging industrial demand isn't going away. The transition to clean energy, the electrification of transportation, the AI revolution, these aren't fads. They're fundamental transformations of the global economy, and silver is at the heart of all of them. So keep watching this space. I'll be tracking silver's movements, analyzing the data, and bringing you updates as this story unfolds. If you found this analysis helpful, smash that like button and subscribe for more coverage on world economy and personal finance topics. And don't forget to drop OG Alex G in the comments below. I want to see who my day ones are. Also tell me your silver price target for 2026 in the comments. I read every single one and I love hearing your perspectives. And remember, this is analysis and education, not financial advice. Always do your own research and consult with qualified professionals before making investment decisions. Thanks for watching, and I'll see you in the next one. Canada? Catastrophe. Exports nurse 30% GDP, US takes 75%. Auto sector, 500K jobs, craters. Alberta oil sands idle. Lumber mills shutter BC towns. Recession odds skyrocket. Bank of Canada warns 2 to 3% GDP shave. Ripples, US firms like GM, 20% Canada production, hike prices globally, eroding competitiveness. Trade war spiral, Canada retaliates on US whiskey, Harley-Davidson's, 2018 redux, Mexico eyes hedges, legal hurdles, Trump cites Section 232, national security, or 301 unfair practices, used before. But USMCA Chapter 32 demands 16-month notice for withdrawal, snap tariffs invite panels, WTO 2, Canada vows disputes, Carney's calculus, US volatility, tariffs, annexation jabs, pushes diversification. China, number 2 partner, 100B trade. Farmers desperate post-US steel spat. but risks alienating superpower. Lessons: trade weaves destinies, one Beijing handshake ripples to Washington. Politics weaponizes economics. Free trade, Ricardo's comparative advantage, versus protectionism, infant industry argument, debate rages 200 plus years. Heroes, Trump shields Rust Belt, Carney hedges bets, free markets utopia or fortress economies. Next, Trump bluffs or blasts, Carney folds or fights. Watch Ottawa. Washington talks, trade molds lives, farmers' harvests, workers' paychecks, your grocery bill. What's fair, loyalty, or sovereignty? Thanks for watching. Smash like if tariffs terrify you, subscribe for updates, comment, Team Trump or Carney, sharpen your global lens.